Hello everyone, welcome to the 60th episode of me learning how to trade in Forex. So in the last video we went through how to use Fibonacci extensions to know when to take profit. We learned about, I guess, when the Fibonacci levels would be. So like for uptrends it will be like resistance levels to take the profit bit. For downtrends, that's going to be like areas of support basically. And then we basically noted that there's no way to know which exact Fibonacci extension level will provide resistance. So it's just any of these levels may or may not act as support or resistance. So yeah, take it with a pinch of salt, I guess. So yeah, and now we're on how to use Fibonacci to place your stop so you lose less money. So let's get started. What is it called? How to use Fibonacci to place your stop so you lose less money. 29/02/2024. Okay. Oh, it's a leap year as well. Damn. Right. Probably just as important as knowing where to enter or take profits is knowing where to place your stop loss. You can't just enter a trade based on fib levels without having a clue where to exit. Your account will just go up in flames and you'll forever blame Fibonacci, cursing his name in Italian. In this lesson, you'll learn a couple of techniques to set your stops when you decide to use trusty fib levels. These are simple ways to set your stop and the rationale behind each method. Method 1. Place stop just past next fib. Methods to place stop levels using Fibonacci. So we got place stop just past next Fibonacci level. So the first method is to set your stop just past the next Fibonacci level. If you are planning to enter at the 38.2% fib level, then you should place your stop beyond the 50% level. If you felt like the 50% level would hold, then you put your stop loss past the 61.8% level, and so on and so forth. Simple, right? Let's take another look at the 4-hour trend, at that 4-hour Euro USD chart we showed you back in the Fibonacci retracement lesson. So this one, if you had shorted at 50%, where's 50%? Right about here, you could have placed a stop loss order just past the 61.8% fib level. So you could place a stop past the 61.8%. The reasoning behind this method of setting stop loss is that you believe that the 50% level will hold as a resistance point. Therefore, if the price were to raise beyond this point, your trade idea will be invalidated. The problem with this method of setting stops is that it is entirely dependent on you having a perfect entry. Setting a stop just past this next Fibonacci retracement level assumes that you are really confident that a support or resistance area will hold. And as we pointed out earlier, using drawing tools isn't an exact science. The market might shoot up, hit your top, stop, and eventually go in your direction. This is usually when we go into a corner and start hitting our head on the wall. We're just warning you that this might happen, sometimes a few times in a row, so make sure you limit your losses quickly and let your winners run with the trend. It might be best if you use this type of stop placement for short-term intraday trends. Best used for short-term intraday trends. Right, intraday trades, not trends. Trades. Method 2, place stop past recent swing high low. Place stop past recent swing high / low. Now, if you want to be a little safer, another way to set your stops would be to place them past the recent swing high or low. For example, when the price is in an uptrend and you're in a long position, you can place a stop loss just below the latest swing low, which acts as a potential support level. When the place is in a downward trend and you're in a short position, you can place a stop loss just above the swing high, and which acts as a potential resistance level. This type of stop loss placement will give your trade more room to breathe and give you a better chance for the market to move in favour of your trade. So place a stop all the way above the swing high. But that means if you're actually wrong though, then the loss on this one would be greater than the loss on this one, wouldn't it? So yeah, if the market price were to surpass the swing high or swing low, it may indicate that reversal of trend is already in place. This means that your trade ideal setup is already invalidated and that you're too late to jump in. Setting large stop losses will probably be the best used for longer term swing type trades. Used for long term swing type trades. And you can also incorporate this into a scaling in method, which you'll learn later in this course. Oh, we met the scaling in method in some other courses. Of course, with a larger stop, you also have to remember to adjust your position size accordingly. If you tend to trade the same position size, you may incur large losses, especially if you enter at one of the earlier fib levels. This can lead to some unfavorable risk to reward ratios, as you may have a wide stop that isn't proportional to your potential rewards. However, may lead to unfavorable risk to reward ratios. May have a wide stop which isn't proportional to your potential reward. So which way is better? The truth is, just like in combining the Fibonacci retracement tool with support and resistance, trend lines and the candlesticks to find a better entry. The truth is, just like in combining the Fibonacci retracement tool with support and resistance, trend lines and candlesticks to find a better entry, it will be best to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss points. As much as possible, you shouldn't rely solely on Fibonacci levels as support and resistance points. Shouldn't solely rely on Fibonacci levels as support and resistance levels as a basis for stop loss placement. As the basis for stop loss placements. Remember, stop loss placement isn't a sure thing, but if you can tilt the odds in your favour by combining multiple tools, it could give you better exit points, more room for your trade to breathe, and possibly a better reward to risk ratio trade. So always combine it. I guess use other tools to I was going to say cross check, but you can't really check, can you? It's just don't solely rely on the Fibonacci one, but incorporate other ones into it. So yeah, that's what I want to say basically. I was going to say something else but I forgot about it, so anyways, summary Fibonacci trading. Summary Fibonacci trading. Let's review what we've learned about trading Fibonacci. The key Fibonacci retracement levels to keep an eye on are 23.6%, 38.2%, 50%, 61.8% and 76.4%. The levels that seem to hold the most weight are the 38.2%, 50% and 61.8% levels, which are normally set as the default settings of most Forex charting software. So levels to look out for are 23.6%, 38.2%, 50%, 61.8%, and 76.4%. Most common ones to look out for are 38.2%, 50%, 61.8%, which are normally set as default settings for most Forex charting software. Yep. Got a nice image of a Fibonacci circle thing. Remember that Forex traders view the Fibonacci tracing levels as potential support or resistance level areas. Oops. Traders view the Fibonacci retracement levels as potential support and resistance areas. And because these levels tend to be closely watched by many Forex traders, the support and resistance levels may become a self-fulfilling prophecy. Similar to the retracement levels, the key Fibonacci extension levels are 38.2%, 50%, 61.8%, as well as 100%, 138.2%, 161.8% extensions. Key Fibonacci. The first one is the retracement levels, isn't it? Retracement levels, look out for. Extension levels to look out for are 38.2%, 50%, 61.8%, 100%, 138.2%, 161.8%. Traders use the Fibonacci extension levels as potential support and resistance areas to set profit targets. Traders use the Fibonacci extension levels as potential support and resistance areas to set profit targets. Again, since so many Forex traders are watching these levels by placing buy and sell orders to take profits, these levels can often become the end of the trend move due to self-fulfilling expectations. In order to apply Fibonacci levels to your charts, you need to identify swing high and swing low points. Swing high and swing low points are needed for identifying Fibonacci levels. A swing high is a candlestick with at least two lower highs on both the left and right of itself. So swing high, candlestick with at least two lower highs on both the left and right of itself. Swing low, a candlestick with at least two higher lows on both the left and right of itself. When using Fibonacci tools, the probability of trading success could increase when used with other fib support resistance levels, trend lines and candlestick patterns for spotting entry and stop loss points. Make sure to use Fibonacci levels with other trading tools, such as trend lines and candlestick patterns. Also check out the book The Complete Guide to Comprehensive Fibonacci Analysis on Forex if you want to further your Fibonacci study. So that's another book right here. Okay, quiz time. Fibonacci races are used in a lot of Forex trading, so you better make sure you know all about them. Brush up on the subject matter by taking this short test. Start quiz. A swing high is a candlestick with at least 2 lower highs on both left and right, at least 2 higher lows. It's definitely not that one. It's got to be both left and right, yep. A swing high candlestick with at least 2 lower highs on both at the left and right of itself. Which of the following is not Fibonacci retracement level? 212. The Fibonacci retracement levels you have to know are 236, 382, 500, 618, 764. When the market's on an uptrend, you would ideally go long. Correct. The Fibonacci tool works best when the Forex market is trending. The idea is go long or buy on retracement to Fibonacci support level when the market is trending up, and to go short or sell on a retracement at a Fibonacci resistance level when the market is trending down. The Fibonacci retracement tool works best when the market is trending. Correct. The Fibonacci tool works best when the Forex market is trending. Fibonacci levels gives you a something probability of success, but they don't always work. Correct. Fibonacci levels give you high probability of success, but they don't always work. The Fibonacci tool should be used in combination with other tools. The Fibonacci retracement tool should be used in combination with other tools. One of the best ways to use the Fibonacci tool is to identify potential support and resistance levels. One of the best ways to use the Fibonacci retracement tool is to spot potential support or resistance levels and see if they line up with the Fibonacci retracement levels. The Fibonacci tool goes well with trendline analysis. A good tool to combine the Fibonacci retracement tool is the trendline analysis. After all, Fibonacci retracement levels work best when the market is trending, so this makes a lot of sense. True or false? You can use the Fibonacci tool to help you find potential entry points. True, right? If you see that trend is developing, you should be looking for ways to go long to give you a better chance of profitable trade. You can use the Fibonacci retracement tool to help you find potential entry points. If it seems that price is stalling on the fib level, chances are that other traders may have put some orders at this level. If it seems that price is stalling on the fib level, chances are that other traders may have put some orders at those levels. This would act as more confirmation that there is indeed some resistance or support at that price. If a fib sticks form right below or right above a fib level, you can just enter a trade at market price, since you now have more confirmation that level could be breaking? No, if a fib stick forms right below or above a Fibonacci retracement level, you can just enter a trade at market price, since you now have more confirmation that the level could be holding. Alright, it's holding, not breaking. In an uptrend, the general idea is to something trade at a Fibonacci price extension level. General idea is to take profits on a long trade. In an uptrend, the general idea is to take profits on a long trade at the Fibonacci price extension level. In a downtrend, the general idea is to something on a trade is to take profits on a short trade. In a downtrend, the general idea is to take profits on a short trade at the Fibonacci price extension level. Yep. True or false? As much as possible, you should rely solely on fib levels. Nope, false. Correct. Just like in combining the Fibonacci retracement tool with support resistance, trend lines and candlesticks to find a better entry, it would be best to use a knowledge of those tools to analyze the current environment to help you pick a good stop loss points. As much as possible, you shouldn't rely solely on Fibonacci levels as support resistance points, as support and resistance points as a basis for stop loss placement. With wider stops and without reducing your position size, you may incur larger losses. Correct. With a larger stop, you also have to remember to adjust your position size accordingly. If you tend to trade the same position size, you may incur large losses, especially if you enter at one of the earlier fib levels. This can also lead to some unfavorable risk to reward to risk ratios, as you may have a wide stop that isn't proportional to your potential rewards. Cool. So that should be holding instead of breaking. Alright, we're on moving averages now, so what's our moving averages? So what are moving averages? Moving averages are one of the most commonly used technical indicators. Why is that not capitalizing? One of the most commonly used technical indicators. A moving average is simply a way to smooth out price fluctuations to help you distinguish between typical market noise and the actual trend direction. A moving average smooths out price fluctuations to help traders distinguish between typical market noise and the actual trend direction. By moving average, we mean that you are taking the average closing price of a currency pair for the last X number of periods. Moving average means taking the average closing price of a currency pair for the last X number of periods. On a chart it should look like this. So moving average of closing prices of the last 10 periods. As you can see, the moving average looks like a squiggly line overlaid on top of the price, represented by Japanese candlesticks. This type of technical indicator is called a chart overlay. Use chart overlay technical indicator. The moving average is overlaid on the price chart, you dig? Like every technical indicator, a moving average indicator is used to help us forecast future prices. Average is used to help forecast future prices. But why not just look at the price to see what's happening? The reason for using a moving average instead of just looking at the price is due to the fact in the real world, aside from Santa Claus not being real, trends do not move in straight lines. Price zigs and zags, so a moving average helps smooth out the random price movements that help you see the underlying trend. By looking at the slope of the moving average, you can better determine the trend direction. As we said, moving averages smooth out price action. There are different types of moving averages, and each of them has its own level of smoothness. Generally, the smoother the moving average, the slower it is to react to price movements. So the smoother the moving average is, the slower it can react to the price movement. The choppier the moving average, the quicker it is to react to the price movement. The moving average is, the quicker it can react to the price. Movement, yep. So, to make a moving average smoother, you should get the average closing prices over a longer time period. How to choose the proper length of a moving average? The length, or the number of reporting periods, including the moving average calculation, affects how the moving average is displayed on the price chart. So the number of why has it gone over there? What? The number of reporting periods, including the moving average calculation, affects how the moving average is displayed on the price chart. The shorter its length, the fewer the data points that are included in the moving average calculation. Or the shorter its length, the fewer the data points that are included in the moving average calculation. The fewer the data points that are included in the moving average calculation, which means the closer the moving average stays to the current price, meaning the closer the moving average stays to the current price. This reduces its usefulness and may offer less insight into the overall trend in the current price itself. So, this reduces its usefulness and may offer less insight into the overall trend than the current price itself. The longer its length, the more data points are included in the moving average calculation, which means the less any single price can affect the overall average. Because you got more data points, so yep, the longer its length, the more the data points that are included in the moving average calculation. calculation, meaning the less any single price point can affect the overall average. If there are too many data points, price fluctuations may become too smooth that you won't be able to detect any kind of trend. Either situation can make it difficult to recognize if price direction may change in the near future. For this reason, it's important to select the length or periods that provides the level price detail appropriate for your trading time frame. Now you're probably thinking, come on, let's get to the good stuff. How can I use this to trade? In this section, we first need to explain to you the two major types of moving averages: simple and exponential. Types of moving averages: simple and exponential. We'll also teach you how to calculate them and gives the pros and cons of each. Just like in every other lesson in the babypips.com school of Pipsology, you need to know the basics first. After you got that on lockdown, like Argentinian soccer player Lionel Messi's ball handling skills, we'll teach you different ways to use the moving averages and how to incorporate them into your trading strategy. It's a very nice image right here. By the end of this lesson, you'll be just as smooth as Messi's. Before we move on, just remember that moving averages smooth out price data as a form of trend following technical indicator. They do not predict price direction. Instead, they define the current direction with a lag. So, why did they say used to help forecast current price future data? They do not predict price action. They define the current direction with a lag. That's a bit of a opposite of what they said. So they said moving average is used to help forecast future prices, but then they said they do not predict price action. So I don't know if they're like contradicting each other, but anyways, are you ready? If you are, give us a heck yeah. If not, go back and reread the intro. Once you're pumped and ready to go, head to the next lesson. Right, okay. Below, so what's this called? Simple moving averages. Average SMA explained. Whoops. Simple moving average is the simplest type of moving average. Basically, a simple moving average is calculated by adding up the last X period's closing price and then dividing that number by X. So just like a basic average calculation. Confused? Don't worry, make it crystal clear. Calculating the simple moving average. If you plotted a 5-period simple moving average on a 1-hour chart, you would add up the closing prices for the last 5 hours and then divide that number by 5. Voila, you have the average closing price over the last 5 hours. String those averages price together and you get a moving average. If you were to plot a 5-period simple moving average on a 30-minute chart, you would add up the closing prices of the last 150 minutes and then divide that number by 5. If you were to plot the 5-period simple moving average of the 4-hour chart, Okay, we know, you get the picture. So it's that number times by that number to get that number, and then divided by, and then that number divided by that number here. Most charting packages will do all the calculations for you. The reason we just bored you on with a how-to on calculating simple moving average is that it's important to understand so that you know how to edit and tweak the indicator. Understanding how an indicator works means you can adjust and create different strategies as the market environment changes. Now, as with almost any other Forex indicator out there, moving averages operate with a delay. Because you are taking the averages of the past price history, you are really only seeing the general path of the recent past and the general direction of the future short-term price action. Disclaimer, moving averages will not turn you into Miss Cleo the Psychic. Here is an example of how moving averages smooth out the price action. 5 simple moving average, 30 simple moving average, 62 simple moving average. On the chart above, we plotted 3 different simple moving averages on the 1 hour chart of USD CHF. As you can see, the longer the simple moving average is, the more it lags behind the price. Notice how the 62 simple moving average is farther away from the current price than the 30 and 5 simple moving averages. This is because the 62 simple moving average adds up the closing price of the last 62 periods and divided by 62. The longer period you use for the simple moving average, the slower it is to react to the price movement. So longer period used for the simple moving average, the slower it is to react to the price movement. The simple moving averages in this chart show you the overall sentiment of the market at this point in time. Here we can see that the pair is trending, an upward trend. Instead of just looking at the current price of the market, the moving averages gives a broader view, and we can now gauge the general direction of its future price. With the use of simple moving averages, we can tell whether a pair is trending up, trending down, or just ranging. There is one problem with the simple moving average: they are susceptible to spikes. When this happens, this can give us false signals. We might think that a new currency trend may be developing, but in reality nothing changed. In the next lesson we'll show you what we mean. We'll also introduce you to another type of moving average to avoid this problem. Okay. So exponential moving average, EMA explained. As we said in the previous lesson, simple moving averages can be distorted by spikes. We'll start with an example. Let's say we plot a 5-period simple moving average on the daily chart of the Euro USD. So that blue line there. The closing prices for the last 5 days are as follows. Day 1, 1.3172, Day 2, 1.3231, Day 3, 1.3164, Day 4, 1.3186, Day 5, 1.3293. The simple moving average will be calculated as follows. So add them all up, divided by 5, because there's 5 of them, to get 1.3209, so that's that there. Simple enough, right? Well, what if there was a news report on day 2 that caused the euro to drop across the boards? This caused Euro USD to plunge and close at 1.3. Let's see what effect this would have on the 5-period SMA. So everything stays the same except day 2 drops from 1.3231 to 1.3. Simple moving average would be calculated as follows, so 1.3163 instead of 1.3209. The result of the simple moving average would be a lot lower and would give you the notion that the price was actually going to go down, when in reality day 2 was just a one-time event caused by the poor results of an economic report. The point we're trying to make is that sometimes a simple moving average might be too simple. If there was only a way you could filter out these spikes so that you won't get the wrong idea. Wait a minute, yep, there is a way. It's called the exponential moving average. Exponential moving averages give more weight to the most recent period. Averages give more weight to the most recent periods. In our example above, the EMA would put more weight on the prices of the most recent days, which would be days 3, 4 and 5. This would mean that the spike on day 2 would be of lesser value and wouldn't have as a big an effect on the moving average as it would if we had calculated for a simple moving average. If you think about it, this makes a lot of sense, because what this does is it puts more emphasis on what the traders are doing recently. So putting more emphasis on what traders have been doing recently. Exponential moving averages versus simple moving average. Let's take a look at the 4-hour chart of USD/JPY to highlight how a simple moving average and exponential moving average would look side by side on the chart. So the exponential is that orange or whatever, or red, and the blue or purple is the simple moving average. Notice how the red line, the 30 exponential moving average, seems to be closer to the price than the blue line, the 30 simple moving average. Yeah, kinda, I guess. This means that it more accurately represents recent price action. You can probably guess why this happens. It's because the exponential moving average places more emphasis on what has been happening lately. When trading, it is far more important to see what traders are doing now rather than what they were doing last week or last month. When trading, it's more important to see what traders are doing now rather than what they were doing last week or month. I'm gonna leave this episode here. So I think we're starting doing the moving averages stuff, or well, we have actually started doing the moving averages stuff. In the next video we're going to be doing simple versus exponential moving averages. So yeah, thank you guys for watching this video, and I'll see you. Peace.